In Ticker, we tend to look for more mid cap, large cap, and mega cap stocks because they tend to be a little safer. Well, my next guest has a hedge fund that specifically invests in small cap stocks. Now, to give you context, he's been able to beat the market for the last 12 years, and most hedge funds, believe it or not, they last between like 3 and 7 years at most. So, beating the market for that long tells us he's doing something right. So, in this episode, he talks about what kind of companies he looks for, what kind of companies he avoids, and what metrics are most important. Please welcome Kyle Mowery. Kyle, welcome to the show.
Good day. Thank you for your time.
Thanks for joining me. So, why don't you kick us off and tell us about your background?
Well, my background is certainly non-traditional. Today, I am managing a small cap equity portfolio. Long and short, I've been doing that for 12 years. So there's a certain longevity there. But originally, I grew up playing sports. I grew up playing baseball out in California, played through high school, college, and then wrapped up my career and said, boy, I sure like doing competitive things and I like numbers and investing just spoke to me, and a couple stops along the way, and I launched Grizzly Rock Capital in 2012.
Nice. Now, prior to starting this fund, you worked in a hedge fund. Is that correct?
Yeah, I had a pretty non-traditional path. I started at a fund of hedge funds called PAMCO, which is now PAMCO Prisma out on the West Coast in an analyst training program.
Sure.
But definitely not the traditional investment banking, private equity background. But then from there, I worked in high yield credit. I really liked how the credit managers thought about risk versus return, focusing on a downside mitigation first. And last couple of years, people only thought about that in 2022. But it's worth thinking about it. And if you're as old as I am, you were investing in the great financial crisis of '08. So
Yeah.
we think about risk every day here, regardless of whether the market's thinking about it or not.
I'm doing the math here, going back 12 years. So you started your fund right there, about '09, 2010, somewhere in there?
Yeah. No, I graduated business school. Let's see, December of 2011. I went in the evening, actually, same program, same degree,
Sure.
just in the evening. And so then I launched right then. I was 29, married, but no kids at the time, and no mortgage. So you can take a lot of entrepreneurial risk when you're 29 with no kids and no mortgage.
Right on. So I have to point this out, and you can correct me if I'm wrong here, but I know the average lifespan of a hedge fund, it can be like, what, about 3 years, 4 years? Is that correct?
It depends on how biased of a source you want to cite. I've heard 7.
Okay.
So that I told my wife when I hit 8 that I was at least above average in this one category, and I didn't have the guts to put that in my letter to clients, but yeah, it's a good verbal joke.
Right on. Yeah, playing a little money ball there, getting above your averages. But at 12 years, that says something, like you're doing something right there. Now, for context with the audience here, if you guys don't already know, Ticker is really focused on, investing in strong value stocks. We like to look at more like mid cap, large cap, mega cap. So we do gravitate away from those small cap and micro cap, but this is your area. This is your specialty. So I want to learn, what are you looking at when you look for small cap?
Yeah, I will try and keep this brief. I mean, so we fundamentally speaking are free cash flow oriented. We're looking for businesses that are mispriced and misunderstood, businesses that can grow and generate owners' earnings and significant cash flow, not only now, but inflecting higher in the out periods. Specifically as it relates to large, mid versus small and micro, I would say that, small caps are a bit of the Wild West. The management teams are usually subpar vis-a-vis mid or large cap. The boards can be absolutely awful. They're there for a salary many times. And we're not activist investors, by the way. These are just, broader comments, things to be aware of. But I think for us, the reason I chose this asset class was it's just less efficient, right? And it's a good way, in my opinion, to have active management into small caps vis-a-vis, some of the, go back to like David Swenson and some of the, looking for asset classes that require active management, and what are those? Certainly, real estate, private assets, private equity, private credit, et cetera, would fall in that bucket. Some of the other things, I don't know much about like crypto, but commodities or whatnot. But small caps are sort of straddling that landscape, in my opinion.
So I was just going to touch on asset classes of small cap. So that does include businesses and real estate.
No, we don't do real estate. I was just using it as an example
Oh,
of
okay.
where it's really hard to use passive indices.
Yep.
There's a case for passive, there's a case for active, for each asset class, but I think it's a lot stronger in, obviously
Sure.
private equity on one side and, you know, QQQ on the other side. There's just more correlation in a large cap manager and QQQ than, between say private equity return streams, middle market, large market,
Sure.
tech versus industrial, stuff like that.
So my audience, they can be quite technical and just give you a little context on what we're looking at within ticker. And you touched on free cash flow. We do look at that. We also look at the revenue. We want to see that increasing year over year for about 5 years. Same thing with net income and EPS. And then going over to the balance sheet, we like to see the assets and equity increasing. So what are you specifically looking for? It sounds like free cash flow is one, but what else?
Yeah, so for us, our holding period is 2 to 4 years.
Okay.
So what we're looking for is an inflection in earnings. And so for us, we would not require 5 years of trailing growth. We do a lot in cyclicals. We do a lot in businesses that all of a sudden screen poorly for whatever reason. Businesses that are coming out of a period of debt pay down and now are entering a period of capital return to shareholders. Businesses where it's an operational turnaround that's been in play, going for a year or two, and you can really do the work, understand the industry, products, the gross margin profile of the business, and then have a sense for what the business could or should look like over the next, again, 2, 3, 4 years, and then that's something that we, after diligence, which is significant, as
Yep.
significant as possible in the public market with public information. That's how we make our return.
I very much align with your strategy there. Although I don't love small cap and micro cap can be very risky, but the inflection point of
Yeah,
earnings, that
yeah,
is something I have talked about our audience a lot is pay
yeah,
attention to those financial, like if you see a
yep,
EPS go from like -3 up to like $1.05, it's like, whoa, what's
yeah,
going on here, right?
yep,
So that's awesome. How do you keep your finger on the pulse of these stocks? Because they're not in the new, they're not the high flying,
yeah,
newsworthy stocks we hear every day, like the
yeah.
Magnificent Seven. So how do you keep your eye on these stocks?
Well, we got a great team. We have my partner Mike Holt here in Chicago, and then Jake Miller, who's out in New York. So we sort of there's a post COVID, COVID enabled virtual sort of company with Jake in New York, and we've all been doing small caps basically our whole career.
Mm-hmm.
And so we have a folder on 800 companies where we've done real work. Now we're not up to speed on 800 companies today with respect to a pencil being sharp, but yeah, probably 150, 175.
Wow.
That would be longs plus shorts. I mean, yeah, but there's three of us, right? And we're all
Okay.
work very hard and have a good knowledge base. So, we don't get them all right. Sure.
Mm-hmm.
The landscape changes. There's a lot going on in the macro economy, Fed, et cetera. But if you get more right than wrong, that's staying power and longevity.
That's it. Can you share with us what kind of returns you're usually returning for your customers?
Yeah, so we run private funds, so I can't disclose that.
Okay.
But let me just say that we are targeting businesses that are going to earn 50+% over 2 to 4 years. 50 would be something like more like a 2 year return. So some of those won't work, some of them do work. So kind of if you do a little math there, you can get into we would aim for a double-digit return, but never get quite exactly there. Sometimes higher, sometimes lower.
Sure.
But yeah, reductions of drawing down is the worst possible thing you can do. You go backwards, clients get nervous, put stress on the team. So our approach is 2 steps forward, 1 step back, 2 steps forward, 0 steps back, and you just kind of keep moving forward in that manner.
That's the game of small caps for sure. So I'm hearing about 2 to 4 year holding period. returns above about 50% over 2 years. Do the simple math, about 25% a year. As you said, double digit returns. That's pretty good. I mean, that's beating the market.
Oh yeah, well, I mean, we get some of them would get wrong, right? So that would come away from that 25%. But yeah,
Sure.
I mean, just directionally, that's the type of thing that we're working on when we're doing our fundamental
Sure.
diligence up front.
Our audience loves hearing lessons learned so they can avoid the same pitfalls. Can you share? You said you don't get them all right. Can you share with us maybe a lesson learned or a stock you shouldn't have invested in and why?
That's a great question. I mean, we we definitely have had a number of these, whether the industry has changed or sentiment has changed. Living in the public markets requires being able to deal with getting a mark every day and a mark set by the marginal buyer or seller, which may or may not be uh, thinking about the same things that you are on a company. I think that for us, some of the the mistakes have been in getting into names that are over-owned by the hedge fund community,
Okay.
things that are very, very popular. And then when everyone wants to exit, everyone's trying to exit at once. They all
Mm,
had a very similar thesis. These are areas that can lead to quick loss in a public market setting, where you got to know not only why the person is selling it when you get in, but who's going to buy it on the way out, right? And so we think about that a lot more than we used to. Fundamentals still ultimately, the earnings power of the businesses for most businesses who are not, narrative driven or story stocks, right, are driven by earnings. And so if you get the earnings right, you're going to get a lot of the move right. But at the same time, if you can enter at a low multiple of earnings and earnings that are rising, that's kind of a double whammy. Sometimes when it's clearly seen, it's priced in. Even if earnings goes up, you don't make much money, and your return on time is lower. My contribution to the industry is a metric called ROAS, and that would be return on analyst stress. If something
okay.
has a low ROAS, we try to avoid it. I did not do that my first 5 or 6 years in the business, and lost a few hairs in the process. But we've learned our lesson.
I love that little humility there. All right. This podcast episode is sponsored by Ticker. Ticker is a platform that helps you manage your own investments with confidence. Check this out. Let's search for Apple. You can see Apple is on sale. That's looking good. Score is 61 out of 100, and margin of safety is 75%. Higher the score, the safer the investment, and the higher the margin of safety, the higher potential returns you can make. In this case, you can see the share price is 175 as of the recording of this video, and the upside potential, the fair value, is 398. All right, let's look at a different stock. We'll go to GameStop. In this case, GameStop is overpriced, scores 39 out of 100. That's not looking too good. And the margin of safety is 0%. Here's some other features within. You can create your own custom dashboard. I like to set up and take a look at the top gainers and losers in the last 24 hours. I also like to take a look at the top search stocks, but you can really customize the dashboard to whatever you want. We have stocks, ETFs, crypto. This is a big one. We have a watch list tool that allows you to add stocks to the watch list. And if anything changes, such as that score or margin of safety, you automatically get notified. I call it the set it and forget it feature. And then we have portfolio trackers and alerts. So if you're looking for strong stocks, want to avoid bad stocks, and learn how to invest, I invite you to join Ticker for free. You're a baseball guy. Can you talk about a home run you were really impressed with maybe the last 2, 3 years?
Yeah, so don't want to cherry pick, so I'll pick something we presented publicly. We're down in Chicago, and in Chicago there's a wonderful charitable organization called Invest for Kids. It's kind of Chicago's version of the Ira Sohn Conference. For here, it raises money for underprivileged communities, kids through different organizations. It's a wonderful organization. The organizers sponsor 100% of the cost of putting it on. So every dollar that's raised goes directly to the kids. And it's a great, so they asked us to come and present an idea. So in the fall of 2019, before the world sort of rolled over into COVID, we presented Darling Ingredients. I believe the stock was in around 19 or or 20 at the time. It's
Okay.
now at 50 by way of 75 or 80. So we were right for the right reason with respect to the what we disclosed, which was renewable diesel, changing business from diesel trucking, primarily in California, to running on chemically identical diesel, which was derived from used greases, fats, and whatnot. So carbon reducing fuel, better for the environment, and certainly profitable for early mover, such as Darling Ingredients. So that was a name that we presented publicly
Mhm.
that had ultimately worked out.
To drill into that, I do talk to the audience a little bit here, breaking the fourth wall. What Kyle places a lot of emphasis on is we talk, you guys know me talking about the four M's, Kyle. So that's the first M is the margin of safety. It's the math part of investing. Then we look at that meaning, moat management. Meaning is a business model. How many revenue streams? How scalable are those streams? Moat. How does it compare to businesses in the same sector? And industry management, of course, is a track record of that CEO or leadership team. So you, in a hedge fund, you really have to place a lot of emphasis, especially when you're looking at small cap, on those other three M's, that meaning, moat, and management. What you just described there really sounds like that's exactly what you're doing.
Yeah, that's the goal. I mean, the unit economics, if you can't distill that down on the product or service, then and really get your arms around it, we don't even try, right?
Sure.
So, something we don't do would be like a lot of like emerging battery technology, because we don't know what the
Mm,
unit economics are going to look like in say 5 to 10 years. So that would be something where we just, even if the story was great, we can't get our arms around it. We might look at it and keep it on our watch list and our radar, but that's not something that's going to get actually into the portfolio for us.
I was gonna dive into what you look for and what you avoid. So, okay, so that's good to know. Like emerging battery tech, you probably avoid. What do you gravitate towards a certain industry or type business model more than others?
Yeah, so we're in we're Midwestern in geography and Midwestern in approach. We do a lot in industrials. We do a lot
Yeah.
in business services, consumer. There's many funds out there that specialize in tech and healthcare, and those tend to be really good sectors for specialists. But we're generalists, so we run pretty
Right.
broad. Um, and that would be real businesses, things that we can understand, products and services, and technological innovation is always there in every industry, but there's some industries that have it more than others. And if you can get your eyes out a few years, and you don't have to go out a decade or more, that is a lot easier for us, for our style and our proclivities. I think that's really important as an investor, focusing on what you're good at, because one investor who's great at VCs or growth equity is going to be completely different than, say, me, right? And they shouldn't try
Right.
and play my game, and I shouldn't try and play theirs. So I think sticking to that lane is so important.
Right. Is aside from the battery example, is there maybe another industry you tend to avoid?
Well, healthcare is just very challenging for a non-specialist, right?
Mhm.
I mean, especially pharma or some of these things. There are some extremely intelligent, a lot of ex-doctors who end up being investors, end up in, these healthcare funds, and you don't want to compete with them unless you have that background. I mean, the skill and talent there is just mind-boggling.
That's really good perspective. In our audience, I joke with, I know I've been in tech about 20 years, so I know that industry. I tend to invest in it a little heavier, but do I know
Sure.
pharma? No, I don't know much about pharma,
Sure.
so I avoid it
Yeah.
like the plague.
Well, and that, for asset classes like that, if you're thinking about an overall broader asset allocation model, there's a lot of wonderfully cheap indexes for things that you can
Right.
active where you can add value, index where you don't. And I think that, kind of that meshes well together overall.
Let's switch gears slightly here. Hedge funds can invest in private and public companies. Do you have a mix of both, or are they all public?
Yeah, we do a few privates here and there. We also do
Okay.
some high yield credit, which is where I got my start. So yes, those would be in our sweet spot, but primarily it's public equity.
Public, nice, good for you. Okay, and then with your fund as your requirements, um, your I'm drawing a blank on the name here.
Yeah, it's a accredited investor. It's a
Accredited.
private fund. Yeah, it's not for everybody, but we tend to have a lot of family offices and high net worth that have been with us for a long time, and we work with certain institutions on a bespoke basis.
Gotcha. Yep. And then do you have a minimum investment size?
Yeah, it's about $250,000.
Okay. Gotcha. To get in. Cool. All right. Well, before we jump to the rapid fire round, is there maybe an investing tip or takeaway you can give our audience?
Well, it's funny. We're sitting here on December the 14th, and the Fed has just come out and said they're going to cut, and stocks are going straight up. Everything's going straight up. Um, I think the more business-like the investing for us, it makes more sense. Playing the market sentiment game can be profitable for a while, but things tend to zig when you expect it to zag.
Mhm.
You and I, Sean, have been doing this a long time, and there's many times where you think you got it dead to rights, and then everything changes. And I think thinking about portfolio optimization and compounding returns over decades requires a process. And so the more process driven and the more, business like the investing process is, that for me has been an area of success historically.
Can you, because some people at a surface level might not know what that means, could you go a layer deeper and kind of explain that from a tactical standpoint, like processes? Maybe explain your process a little bit.
Yeah, well, not too dissimilar from 30,000 feet from yours. You're looking for a sort of a growing earnings stream, whether it's revenue, profit,
Mhm.
whatnot, as you enumerated a bit ago. For us, it's similar, but we can have a little bit more esoteric companies because we'll do cyclical companies,
Sure.
companies that are cyclical. But just at its base level, it's understand the product, understand the margin profile, understand how that's going to translate to earnings, and then understand the management and the board. Because when you're investing in a public security, those people are allocating your capital. And a lot of times you go online and punch in a ticker and hit buy. That's great, but there's actually people running that business. So who are the people and what are the capital allocations decisions they're making? I'd say many small caps that appear attractive are actually wildly unattractive due to poor capital allocation. You see it everywhere all the time. If that's what you do is study small caps all day, which we do. So yeah, I would just say, study the business, study the capital
Yeah.
allocation. And if you believe that the market is missing something, that's when, that margin of safety, the difference, margin of safety is just a difference in prices, what you pay, values, what you get, to quote, Buffett. Um,
Hmm.
that's the fundamental tome of value investing.
Right on. Right on. Awesome. Love the strategy here. Thanks for the insight on small cap investing. But let's transition to the rapid fire round. This is the part of the episode where we get to find out who Kyle really is. If you can, try to answer each question in 15 seconds or less. You ready?
Oh boy, 15. Okay, rapid fire.
Yes, indeed. All right. What is your favorite podcast?
Well, I'm personally friends with Bill Brewster, who hosts the Business Brew. Um, so I would probably select that one.
Okay. What is a recent book you read and would recommend?
Yeah, I read mostly for investing, but over the summer I read Peter Attia's Outlive. Phenomenal book, and actually really deep on the mental and emotional side at the end. So definitely read the full thing.
Okay, good to know. All right. So we've got the movie question here. What is your favorite movie?
Oh man, there's so many. To pick one single movie, probably I I don't even know.
Here.
Braveheart.
Okay, we've heard that one. Let's narrow it down to, because you're a sports guy. What is your favorite sports movie?
I used to watch Major League before every baseball season started. Now that's dating me. So
It's a great movie, classic Charlie Sheen, right? All right. What is the worst advice you ever received?
if you're smart, you don't have to sell.
Hmm. And flip that equation. What is the best advice you ever received?
One of my investors has been a partner, over here for over a decade. Very successful individual. Everyone would have heard his name. He said, "Be true to who you are. Be true to yourself." And most people have these skills, and if they a certain skill set, and if they apply it, things go well for them.
Right on. All right. And last question here is a time machine question. If you could go back in time to give your younger self advice, what age would you visit and what would you say?
Oh, I go back to 2012 and I started the fund and say, go long big tech.
Right on. Sweet. All right. Well, where can people reach you?
Yeah, it's our business is private, but info at grizzlyrockcapital.com if you want to get on our list, assuming you're accredited. Also, we have a sister business that has a Twitter handle, Covest Select, on the Twitter machine. That business invests in single name public equities. So,
Awesome. All right, Kyle. Well, thank you so much for your time.
thank you, Sean.
All right. We'll see ya.